Well, the rally that we've seen so far in the S&P 500 has been tremendous. Year to date, it is the best start to, or the best year-to-date gains of the 21st century. And in fact, over the last year, it is up, as you can see, 33% more than that on a total return basis. It is partly for that reason that our next guest says the S&P has simply overshot, and he's warning of some potential downside in 2025. Let's bring in Barry Bannister, Stifel's chief equity strategist. Barry, thank you so much for joining me. Okay, the floor is yours. Walk me through your thinking and why you are a little bit concerned about the levels that we're at right now.
Yeah, you mentioned S&P 500, or what we call SPX on the Bloomberg. It's up about 40% year over year. Now, we know October a year ago was the low. We were super bullish in October of 22 and October of 23, precisely. I'm more of a bottom fisher than a top ticker, so, take it with a grain of salt. But 40% year over year has been an effective barrier for a quarter of a century. And it's very difficult for the market to sustain these gains. There are a lot of very technical, fundamental reasons why there's going to be problems going forward, and we should probably talk about them in the economy and the Fed. But this market is feeling, if not, it's not a bubble, but it's effervescent like Alka-Seltzer. And I honestly need Alka-Seltzer every time I look at it because it turns the stomach a little bit. The optimism and the mistakes that are being made by the central bank.
Well, let's talk about what those are, because this is a market that's moving higher as earnings are growing. We're on the doorsteps of a technological revolution in which the S&P is over-indexed to, and we're nailing something we didn't think was possible. We're getting economic growth at the same time that we're getting rate cuts.
Well, if I go back and look at valuation, we like to look at equity risk premium using a CAPE on operating. So we take Schiller at Yale's CAPE. We look at the operating, not GAAP basis. And then we compare it to a 10-year TIPS real yield. That's the risk-free rate on offer that you'd compare an earnings yield to. All the major bull markets in the last 80 years or so have occurred with brand new technologies. In the 50s, nuclear was a big deal. And in the 60s, 70s, computers and semiconductors just came on the scene, and they were a big deal. Big part of the Nifty 50 was computers. Then you go back to the 90s, it was the internet and fiber optics, and now it's generative AI, which, by the way, is not really revolutionary. It's more using the data we already have from the internet. So I would call it an advance on top rather than a new technology.
You mentioned that cyclically adjusted price to earnings ratio. Is it valuation that is your primary concern here?
Well, it's also the macroeconomic overlay. We do think that inflation has the first spark, the first shot across the bow is rarely the last. We are now, I don't know if you've noticed it, but we're in a highly political environment right now in the United States. Populism is here, and it's here to stay. And the battle in this election is really over what brand of populism, right or left-wing populism, will prevail. But there's absolutely no doubt and no question that populism has won. And so we will see large government spending going forward, lots of juice in the economy on nominal GDP. It will outpace interest rates. And I don't mean to sound like an MMT person, but it will outpace the interest rate. And we will see a little more inflation mid-decade, 25 into 26. The Fed then having to play catch up will just cause this unnecessary volatility. And that's what you were referring to earlier when I had said that we could go up and then back down very quickly over the next year.
Well, it's nice to see a modern monetary theorist out in the wild. We haven't heard from that group in a while. When you talk about that downside, and I think your price target implies something like 26% downside, what's the prudent thing to do if you're an investor and you're listening to a Barry Bannister of Stifel warn in a chorus of bulls saying, buy the dips, buy the dips, buy the dips? What is the thing to do when you hear somebody like yourself warning of a 20% drop?
Well, look, I freely admit that, I mean, you can go back in my notes 20 years. I'm very good at getting the bottom of stock market drops within days, but I'm not good at tops. The bubbly, effervescent personality that just gets so excited at the tops, it's just not me. I am not that bubbly person. So, within the context of what I'm saying, it looks to us that if we follow a composite of all past market booms, manias, a little bit bubbly, if you want to call it that, of all of them in the past, we could go as high as another 10% up on the S&P to around 6,400. But then, as the inflation picks up in 2025, assuming full resource utilization, we never had the corrective behavior in the economy, the recession that was necessary. Then the Fed having to play catch up, we will probably go back down 25%, and that would take us to 4750, which is where 2024 began on the S&P 500. So can you imagine the loss of credibility for investment markets in a highly widely owned market? The politics of the Fed and then the Fed encouraging this market by talking up rate cuts. The politics of what they're doing is abysmal. The Fed should definitely take stock in what they're doing, because they are encouraging wildly speculative behavior, whether the technology or the market multiple or the money flows, whatever you want to look at. They are encouraging this, and they're creating a real problem.
Well, is it similar to criticisms that we heard during the pandemic when you saw those rates coming down, and you could argue that the animal spirits were even more greatly unleashed?
Well, if you use CAPE on operating and you look at what's called earnings yield or earnings over price, it's just an upside down PE. We got to about 33.33 times 10-year trailing operating earnings, inflation adjusted. That's what a CAPE is. So we could go back to 3%, just like we were at 3% in 1999 to early 2000. Not a lot of investors today were around 25 years ago, but I'd already been an analyst for 15, almost 20 years by the time the 2000 tech bubble blew up. But if you look back then, it was 3% operating earnings yield on CAPE, 3% in 2021 at the peak on December 31st, rolled over January 4th, and 3% would get you to 6,400 by the end of this year, beginning of next year. Just a mistake for the financial conditions index, for the Fed, for policy to be signaling that kind of exuberance. It's part of the Fed's job to rein in all forms of exuberance, and that includes equities. It's a debate that's been going on, though, in finance since the 1990s with Greenspan. I don't know the answer as far as what's going to happen, but I can tell you what should happen.
Well, tell us where we should go in this situation. I mean, that's part of the argument of why gold has done better, in part because of concerns about credibility. Is that an area that you would look to? What should an investor do to brace themselves against this?
Well, think about when you buy gold, you're just really buying a weaker dollar, better global economy, weaker dollar environment. You're buying lower real rates, so you're buying some reflation with still low interest rates out 10 years, so the real after inflation yield has to be falling. I wouldn't get too excited about that kind of a call just yet unless China really pours on the fiscal, and then that would engender a rally in gold if you see a huge stimulus fiscally out of China, but we haven't seen that yet. Now, if you look at the stock market as a whole, what it wants to believe now is that inflation is whipped forever, that 2021-22 was just a distant memory. But based on an analysis of all periods in the last 100 plus years, what we find is it was actually just the first salvo in what will be another move up, not that high, maybe 5-6% by 2026, 2027, but enough to cause a severe reaction by the central bank on an outgoing Fed chair, Powell, in May of 26. And then you'll get your bear market, and you want to be pure out defensive or in cash. But right now, it still believes that inflation is low. And we actually think inflation gets stuck around 2.8 on the core PCE, which is so far above the 2% Fed goal that one has to wonder if they're going to give up on that goal.